In this video, we're going to be discussing two strategies that YouTubers out there are not telling you about IPOs in order to get them at a potential discount. In addition, we'll go over some of the basics of an IPO. Sound good? Let's get started. So welcome everyone. My name is Juan. I am glad you can join my channel. This is actually my first video. The first thing is, I'm gonna keep it simple and make sure that everyone that's watching understands what I'm talking about. So I'm gonna go down to the basics and tell you what is an IPO. The second thing will be, why do companies IPO? And the third point is two strategies that you can use in order to try to get IPOs at a discount. And before we get any further, this video is for entertainment purposes only. I am not a financial advisor. This is not financial advice. All I'm providing here is my opinion. So the first thing we're going to discuss is, what is an IPO? IPO stands for Initial Public Offering. So what does that mean? It basically means that it's a big transition for a private company into a public company, which means your shares are going to be traded in the New York Stock Exchange or the NASDAQ, for example. And this IPO process facilitates investors in the company to be able to buy and sell shares of that company. Now, point number two is, why does a company IPO? There's three main reasons. The first one is to raise capital, right? And why do companies want to raise capital? Well, one of the reasons is for growth. So think about, like, if you're a Chick-fil-A, hopefully they'll IPO soon. I'm sure everyone will be happy about that. They might raise that capital in order to open new stores, expansion into new markets, or expansion into new distribution, or to launch a new product. So think about Tesla. When they did an IPO, that's what they used the money for, to launch the Model S. Now, another reason why companies raise capital is pay down debt. So maybe they have a very expensive loan that they had in the private markets, so they're trying to pay that off. And the other two reasons why companies raise capital could be something like an exit strategy for the original investors of the company. And then the last one is just to gain publicity. Some companies try to market themselves that way by going to the public markets, not necessarily needing that cash for growth. Now let's get down to the meat of the video. This is the point number three. How do you get IPOs at a discount? Well, first of all, think about at a discount to what? So what we're talking about here is the offering price, right? The offering price is different than the launch price of an IPO. So a good example is Roblox, that they IPO'd earlier this year. So their offering price was $45, which is usually what institutional investors pay for the deal, right? But retail investors usually cannot get that price. The launch price is what we can buy it at. And that launch price for Roblox was $70. So what are the two strategies that you can use in order to get IPOs at a discount? First one is called buy in thirds, which I think it's the easier approach. And then the second one is called wait and watch. And I think it's a more difficult approach. So buy in thirds is pretty straightforward. So say you have $9,000 to invest, you basically are going to divide that in three. So you're going to buy at the launch price, whatever that is for that IPO, $3,000. And then at a later date, you're going to add another $3,000 to that investment. And then at a later date, another $3,000 to that investment. And that time frame could be, it's depending on the company. It could be 2 months, it could be 3 months apart, it could be 6 months apart. But I'll give you a good example. You have Facebook, and I know it's from 2012, so just bear with me, but it's a good example to show you how this works. Facebook offering price was $38. But on that day, when it launched, it went up to 42, right? And it closed down at 38. So let's just assume that, you could have gotten it at 38. So if you would have used the buy in third strategy, you would have bought it at 38 the first time. Then 6 months later, you would have bought it at 23, and change. And then a year later, you would have bought it at 26. Now, that gives you an average price per share of $28 versus the $38 that you could have gotten that day, or 42 if you would have bought it at, when it launched, which was 42. So that right there tells you that this strategy works and you can get a discount to the offering price of this stock. Now, the second strategy is called the wait and watch strategy. Now, this one I say it's harder, more difficult in the sense that you have to be patient and you can't jump into something just because you like the stock. So going back to the Facebook example, using the wait and watch strategy, this is what would have happened, right? The offering price was 38. Only 3 months later, dropped to a low of 18. So that gives you an idea of, if after 3 months you really like a stock and it drops by about 50%, it is time to buy. And it is time to buy a lot. So basically all of your investment at once, not like we were talking about before, splitting the investment in 3. Now, why I think it's important to use one of these strategies is because, and I'll put this chart up, is because from this study, which was done from IPOs from 2010 to 2020, you can see that one of their takeaways is that the more time passes, the more IPOs underperform the market. And here it shows that 2/3 of the companies actually underperform the market by 10% or more. And only, and this is the second point, 29%, or about 1/3 of the companies outperform the market. Some do very well, 2 to 3 times more or better than the market. So there are opportunities in the IPO market, but I definitely think that these two strategies can help in minimize the losers and maximize your winners. Let's now look at some recent IPOs. The first one that I have here, this is Coinbase, that launched their IPO in April of this year. My first thought is, are we there yet? Right? It looks like it just continues to drop from their offering price at $381. So we're down, 30 something percent. I mean, over $100 a share now. What Robinhood just said about trading volumes declining, I think it's one of those that will probably continue to go a little bit lower before it becomes a good deal. So if you're interested in that one, I would say, wait and watch. The next one I have here is Dunkin' Donuts. They actually just IPO back in July, so last month. They're the competitor to Dunkin' Donuts. I don't know if you guys have ever tried Krispy Kreme, but I am telling you, they are delicious. I prefer them over Dunkin' Donuts, but I'm sure there's a lot of people that prefer Dunkin' Donuts. But anyways, I mean, they are down in less than, the 2 months or almost 2 months. They're down about 20%. They issued their offering price was $17 a share, and then it jumped the day of the IPO to 21, and now it's down to this level, which looks pretty interesting to me, right? This could be one of those that either strategy would work. The other one that I have for you guys that was recent, and to show you that, this is not a perfect, nothing in the stock market is perfect. This is, there's always exceptions to the rule, and this is probably one of them. This one is Monday.com, which, the stock has just continued to go up from their offering price, which was again in June. And it was $155, the offer price. And as you can see, it's just keep going up. So I'm sure they are performing well. They are keeping up with their expectations. And this is one of those that maybe if you want to get in, or if you didn't get in, this may be the one that you can try the 1/3 strategy, just in case it pulls back. So you can get a little bit better pricing for, some of the investment that you do as you go along with this stock. Now, talking about good performing stocks, I have one here that I'm sure everyone is familiar with, and that's Snow. Let me show you the chart. So this one, the reason why I'm bringing it up is it was one of those that it was a FOMO stock. It still has high expectations. It's in a solid industry, got plenty of growth ahead. But the price, to me, from the launch was just over the top, right? The offering price was $120 a share, and that was even much higher than what they expected it was going to be. So it got raised several times, and it was finally priced at $120 a share. However, it opened up at $245 a share. Now, it has gone as high as 480 or something. It has gone really high up. It came down to around $180 a share in May. So that was about 8 months later. And this is one of those that I would have done a wait and watch strategy. It's a perfect example of that, right? The FOMO type stocks. And see, you could have gone it at $180 versus $245 or who knows, $400 if you were, in FOMO mode when the stock just kept going up. Now I have two more stocks that I want to show you from 2019. The first one is Lyft, and their offering price was $72, but it shot up to $87 the first day. And as you can see from the chart, it's been down since then, right? And obviously they got hit with COVID as well in last year, but this is one of those exactly that I'm talking about the wait and watch strategy, that you could have waited, been patient, and anywhere in the 2000, I guess after February time frame, you could have bought that stock at less than half the price that it was on the first day that it started as a public company. Or even now, actually, if you see the chart as well, it's around $49, and that's still below the offering price. So if you really liked it 2 years ago, this might be the time to buy. Even though, of course, we're dealing now with the Delta variant that could put some headwinds to the performance of this company. But still, if you believe in it long term, then this might be a good time to get in. And now the other company that I was talking about that I wanted to mention is Smile Direct Club. This one, if you can see from the chart as well, it's just been straight down, right? They had also problems during COVID, but they recovered a little bit, but they're going back down again. And to put this one in perspective, their offering price was $23, and now it's down below $5 a share. So that is, down about 80%. So if you really believed in this company, like this company back then, at this price, it should be a no-brainer. I have to believe that the institutional investors that bought this company back in 2019 did their due diligence. One thing that I know about this company is that, they have missed expectations. Their growth is not as fast as what people thought it was going to be. But at the same time, their revenues here are going to be comparable to 2019. That gives me some confidence, right? Obviously not the expectations that people thought, but they are still performing around what they were performing at back in 2019. But that's a discussion for a different video. I don't want to get into an analysis of this company in this video. Well, guys, that's all I have for you today. I hope you liked the video. I know there's a lot of information there. And if you have any questions, let me know in the comments below. If you liked the video, please consider giving it a thumbs up and also subscribing, because I will be posting more videos soon. Let me know what strategy would you consider next and what IPO are you looking into. I hope you have a good one. See you in the next one.